It all points to revaluing the price of gold, which is held in the gold revaluation account. Every $4,000 increase in the price of gold gives the Treasury General account $1 trillion free and clear. President Trump would tell Scott Bessent, tell Jerome Powell to revalue the gold, please. Doesn't even require congressional approval. It's in his prerogative to do so. It would allow treasuries, which are losing demand, to once again be perhaps in demand. It would inspire confidence. It would inspire transparency, especially if put on a blockchain like Elon is talking about. It would give us the ability to start to pay down our debt. At the same time, what does rising gold do to the dollar? Oh, it weakens the dollar. The dollar falls in comparison to a rising dollar. That's what Trump wants. And so, look, I think that it's an option. My mentor, Richard Russell, used to say the Fed has but two options. This is 15, 20 years ago, and they're way more indebted than they were then. He said they have two options, but to inflate or default. Well, maybe option number 3 would be to revalue the price of gold, which indeed would inflate the dollar, but would get us on a pathway perhaps to reigniting the confidence that stands behind our treasury market, would give us the ability to start to pay down. Now, you want to take it way out into the stratosphere, but in a world where Bitcoin is $100,000, Jeremy, I remember 2017, it was $400. In a world where Bitcoin is $100,000, just what if, I'm just saying for what if they made gold $140,000, just like that. And they say, we will pay $140,000 to any sovereign nation who wishes to deliver their gold to the New York Fed or to Fort Knox, and we'll pay it. Now, I'm not saying they're going to, but if they did, the $6 trillion debt would be completely wiped out. Are they going to do it? Probably not. But my point is, even at $10,000 an ounce, as guys like Jim Sinclair have said, hey, you got James Rickard, who's been on your show before, he says $24,000 ounces, his number. You put gold at $24,000, that means you just gave $6 trillion free and clear to the Treasury General account to work its way out of this debt burden, to inspire confidence, to peg it to the treasuries. And Judy Shelton said to me, Andy, you know, I was very close with Trump in his first administration. She was the Federal Reserve nominee for Trump, wasn't confirmed, but she said that they discussed issuing these treasuries long and hard, and says it is her belief, and I believe she'll be on the Federal Reserve Board this time around, but it is her belief that he will issue treasuries backed by gold on July 4th, 2026, the 250th year anniversary. She told me that. She told me she believes Fort Knox will be audited, and she told me, not in so many words, but more or less agreed that gold will be revalued to a much higher level to do this. Now, if it really was going to be in 2026, you have to have all the pieces in place before you say, here's our new gold-backed treasury. These pieces, you know, you look at all the dots, you look at all the facts, Jeremy, and I mean, in and of themselves, they're all pretty significant. Put them together and it's like, man, could this be the picture that I'm seeing? Could it be? Maybe I'm stupid enough, or maybe I'm onto something to say it out loud. My feeling is that they are planning something much bigger for gold than we're all have been led on to believe, that it's just repatriating it to take advantage of the spread between London and New York, or to backfill in case for these naked contracts that need to have gold backing if there are those that stand for delivery.
Beyond investment fundamentals, silver also presents a strategic advantage in times of government intervention. Throughout history, governments facing economic crises have restricted or taxed gold ownership as a means of controlling capital flows. In 1933, the U.S. government enacted Executive Order 6102, which effectively outlawed private gold ownership and forced citizens to turn in their gold holdings to the Federal Reserve. While a similar move today would be more difficult to implement, it is not outside the realm of possibility. Silver, on the other hand, is less likely to face such restrictions, as it is not widely regarded as a monetary asset in the same way gold is. This makes silver an attractive alternative for those looking to preserve their wealth without attracting government scrutiny. Another major factor driving silver demand is the ongoing supply deficit. Unlike gold, which is mostly stored and retained, silver is often consumed in industrial applications and not easily recovered. For the past 7 years, global silver demand has outpaced production, leading to supply shortages that have yet to be reflected in market prices. The Silver Institute has repeatedly reported supply deficits, indicating that future shortages could cause silver prices to spike dramatically. Once industrial buyers begin facing difficulties securing enough silver to meet their production needs, the market could experience a historic price surge similar to what was seen in past silver bull markets. The broader implication of this financial shift is clear. Gold and silver are not merely hedges against inflation, but essential stores of value in a world where fiat currencies are failing. Investors who recognize this early have the opportunity to protect their wealth and position themselves for enormous gains as the financial system undergoes a historic transformation. However, the time to act is before the crisis becomes fully apparent. Once the collapse of fiat confidence is widely acknowledged, gold and silver prices will no longer be available at current levels, and obtaining physical bullion will become significantly more difficult. For those looking to prepare, the most important step is to own physical gold and silver rather than relying on paper-based investment vehicles such as ETFs or futures contracts. Physical metal eliminates counterparty risk and ensures that your wealth is not tied to the solvency of financial institutions. Additionally, diversifying storage locations, such as keeping bullion in private vaults outside the banking system, provides an added layer of security in the event of government intervention or capital controls. The future of the global financial system is uncertain, but one thing is clear. Fiat currencies are losing their value, and gold and silver are regaining their place as real money. The collapse of the current monetary order will be a defining event of this century, and those who prepare now will be among the few who emerge with their financial stability intact. As the Great Reset unfolds, the choice is simple. Cling to a failing fiat system or move toward assets that have stood the test of time. The window of opportunity is closing, and those who act now will be the ones who control real wealth in the new financial era. Revaluing gold would also have significant geopolitical implications. The global financial system has been shifting away from US dollar hegemony, particularly with the rise of the BRICS nations: Brazil, Russia, India, China, and South Africa. These countries have been actively working to reduce their reliance on the dollar in international trade. China has been leading efforts to establish alternative financial structures, including bilateral trade agreements that settle in gold or local currencies instead of dollars. The BRICS bloc has also discussed creating a new international currency backed by commodities, potentially including gold. If the US were to revalue its gold reserves and introduce a form of gold-backed treasury security, it could counterbalance these global shifts and reassert the dollar's dominance in global finance. For investors, the implications of a gold revaluation are clear. Those who hold physical gold would see a substantial increase in their wealth, as their holdings would be revalued along with the official price. However, those who rely on paper-based gold investments, such as exchange-traded funds, ETFs, or futures contracts, may not experience the same benefits, as these instruments often carry counterparty risks. Additionally, if a revaluation were to take place, there could be new government regulations or restrictions on private gold ownership, similar to what occurred in 1933 when the US government confiscated gold holdings and reset the official price. This possibility highlights the importance of securing physical metal in private, accessible locations outside the banking system.
No, I think it's way deeper than that, Jeremy. I think there's something in store for gold, which is what? The only other tier one reserve asset in the world that all the central banks are buying hand over fist. It would benefit them all of the central banks. And maybe that's what the plan has been all along, not sure. But why else would the most powerful bank on the planet, the most powerful, the BIS, reclassify gold as the world's only other tier one? I'll let your listeners think about that and decide for themselves. For me, there's a plan in motion that the insiders, the central banks, have known about for a long time.
Yeah.
We're just finding out as it progresses. And you could, for the last several years, that it's been China and the BRICS nations who have certainly gotten out to a massive head start. Mm-hmm. And maybe that's why you're seeing such enormous amounts. I mean, Trump doesn't do anything small now, does he? And maybe that's why you're seeing such an enormous race since November. I mean, if they took a look and said, do you understand what Trump was talking about the BRICS and losing the world reserve status on his campaign trail and said this would be worse than any lost war? And he's right. And he saw what they were doing. And maybe that's why he brought in Scott Bessent, whose largest holding is gold. And maybe that's why since November, not since he took office, but since November, the insiders were alerted and start repatriating their gold. I mean, we have a long way to catch up, but I would argue that in my mind, look, the Chinese are the largest producers of gold in the world, pretty dang close to the largest producers of silver also. It's arguable our first or second. They're net importers of both. They hardly sell an ounce ever. They became net importers of silver recently. They were net exporters. They're flying the world buying doré and concentrate. They're buying up with their Belt Road Initiative. All of the countries that they're associating with are massively resource rich and underdeveloped. So they help them build roads and bridges and maritime channels and railroads and gold and silver mines and refineries for a piece of it, and industrialize their countries and bring those resources to the market. They get a piece of it. They understand. You see, the difference is the Chinese think in terms of decades, we think in terms of days, and that's a problem. They have been very methodical in their accumulation and in their production, and their numbers stood at 1,200 tons half of my career. And everyone said, I call BS. That's not true. They never update their numbers. Everyone always said you can't believe the numbers that they say. They have way more. If you just take the 300 to 500 metric tons a year since 2000 that they've been mining, they have way more than we do. Alistair McLeod, one of the smartest dudes I've ever met, 2 years ago said they have 38,000 metric tons, 20 by the state and 18 by the people, probably a whole hell of a lot more now. So China's way out in front, but it seems, if I'm seeing this correctly, that moves are being made, if you will, Jeremy, to narrow that gap by the United States.
The transformation of the global monetary system is accelerating, and gold is at the center of this transition. While the first part of this discussion focused on the mechanics of gold revaluation and its potential impact on the U.S. economy, this section will explore the broader geopolitical implications, the role of gold in the emerging financial order, and how silver may play a complementary role in this evolving landscape. The steady movement of central banks toward gold accumulation is not merely a hedge against inflation, but a deliberate strategy to reshape the international monetary system. As confidence in fiat currencies erodes, the world is shifting toward a reality where gold-backed assets may once again become the foundation of global trade and finance. One of the clearest signs of this transition is the increasing de-dollarization efforts by major economies. Over the past 2 decades, China, Russia, and other emerging nations have been aggressively reducing their dependence on the US dollar. This is evident in the declining share of global trade conducted in dollars and the rise of bilateral agreements that settle transactions in local currencies or gold. The BRICS nations have been at the forefront of this movement, with China and Russia leading efforts to build a parallel financial system that circumvents Western-controlled institutions such as the International Monetary Fund, IMF, and the SWIFT payment network. A key element of this strategy has been the massive accumulation of gold reserves by these countries, signaling their preparation for a monetary reset that could challenge the dollar's dominance. For the United States, the revaluation of gold could serve as a countermeasure to these shifting dynamics. If gold were to be revalued at a significantly higher price, it would strengthen the U.S. Treasury's balance sheet and provide a new financial instrument to restore confidence in U.S. debt markets. The issuance of gold-backed Treasury securities could attract investors who have been moving away from traditional dollar-denominated bonds. Some experts speculate that this transition may be formally announced as early as July 4, 2026, coinciding with the 250th anniversary of the United States. Such a move would mark a return to a partial gold standard, reinforcing trust in the U.S. financial system while competing with the emerging gold-backed trade mechanisms being developed by rival economies. The prospect of a gold-backed monetary system raises important questions about how such a shift would impact global markets. In a world where fiat currencies are continually being devalued, a fixed gold price would introduce stability in international trade and investment. It would also force central banks to adopt more responsible monetary policies, as excessive money printing would be constrained by physical gold reserves. While this would mark a significant departure from the current system of floating exchange rates and unlimited fiat currency expansion, it could ultimately restore discipline to global financial markets and prevent the unchecked debt accumulation that has defined the past several decades. In this context, gold's role as a strategic asset cannot be overstated. Unlike fiat currencies, which can be printed without limit, Gold's supply is finite and tightly controlled. Central banks understand this, which is why their purchases of gold have reached historic highs. In contrast to past periods when Western nations actively suppressed gold prices to maintain confidence in fiat money, we are now witnessing a situation where governments are openly accumulating gold, signaling its increasing importance in the future financial order. If central banks continue this trend, private investors will likely follow, leading to even greater demand for physical bullion. While gold is expected to take center stage in the coming monetary reset, silver remains an overlooked but equally important player. Unlike gold, which is primarily held for monetary purposes, silver has a dual function as both a financial asset and an industrial commodity. The rising demand for silver in industries such as solar energy, electric vehicles, and electronics has created supply shortages that have yet to be fully reflected in its price. At the same time, silver's historic role as a form of money suggests that it could also benefit from a return to precious metal-backed financial instruments. The current gold-to-silver ratio, which hovers around 90-1, indicates that silver is undervalued relative to gold and could see explosive price movements if the monetary system shifts toward tangible asset backing. The increasing scarcity of silver is another factor that could drive its price significantly higher. Unlike gold, which is mostly stored and reused, silver is heavily consumed in industrial applications, leading to declining reserves. The Silver Institute has reported continuous supply deficits for the past several years, with global silver demand outpacing mining production. As industries continue to expand their reliance on silver, particularly in green energy initiatives, shortages are expected to become more pronounced. If gold undergoes a significant revaluation, silver is likely to follow, as its monetary and industrial applications will become more valuable in an era of declining fiat currency confidence. Another important aspect of this shift is the potential for government intervention. Historically, during times of economic crisis, governments have imposed restrictions on gold ownership to maintain control over monetary policy. While outright confiscation is unlikely in today's world, there could be new taxation measures, capital gains controls, or transaction reporting requirements imposed on gold investors. Silver, however, remains largely outside the scope of such regulatory concerns, making it a compelling alternative for those seeking to preserve their wealth without the risk of excessive government interference. The geopolitical consequences of gold revaluation extend beyond the financial markets. A world where gold plays a central role in monetary policy would create a more multipolar financial system, where economic power is less concentrated in the hands of a few dominant currencies. This could benefit emerging economies that have historically been at a disadvantage under the current system, where the US dollar serves as the global reserve currency. Nations that have been accumulating gold, such as China and India, would see their financial influence grow, while countries that have failed to secure adequate reserves may find themselves struggling to adapt. In such a scenario, economic alliances could be redrawn based on gold reserves and commodity-backed trade agreements, leading to a restructuring of international financial institutions. For investors, the key takeaway is that the global financial landscape is shifting, and gold and silver will play a central role in the next phase of economic history. The days of unlimited money printing, artificial interest rate suppression, and unchecked government spending are numbered. Whether through a formal gold revaluation or a gradual market-driven shift, the value of physical assets is being reasserted, and those who position themselves accordingly will be best prepared for the transition. As this transformation unfolds, the most prudent strategy remains the direct ownership of physical gold and silver. Unlike paper-based investment vehicles such as ETFs or futures contracts, holding tangible metal eliminates counterparty risk and ensures financial sovereignty. As trust in fiat money continues to erode, securing real assets outside the traditional banking system becomes not just an investment decision, but a necessary measure for wealth preservation. In conclusion, the revaluation of gold is not merely a theoretical possibility, but an increasingly probable event that could reshape the global financial order. The forces driving this shift, rising government debt, declining fiat confidence, central bank gold accumulation, and geopolitical realignments are already in motion. Silver, often overlooked in discussions of monetary policy, stands to benefit tremendously from these trends, as its dual role in industrial applications and financial markets positions. It is one of the most compelling investment opportunities of the coming decade. Those who understand the significance of this transition will be the ones who protect their wealth and thrive in the new financial paradigm. The world is preparing for a monetary reset. The only question is whether you are.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.